So there has been a larger extent of deleveraging already. There is some resumption. One of the challenge of a policy like the Federal Reserve has, or many advanced economies central bank has, to create all this liquidity to get your economy going, and that's after all your job, especially when inflation is very low. Actually, you're a bit too close to zero for comfort. But the risk is that this money goes into financial market and fuels some excesses. So what you try to do there is to have, again, this so-called macroprudential rules. And an example is Switzerland, where we have a very expansionary monetary policy because we prevented the appreciation of the Swiss francs vis-à-vis the euro. But then there's the issue about real estate bubbles, and that's why the Swiss National Bank, in cooperation with a regulatory authority, is putting additional restrictions on lending. So, for instance, you have to bring a lot more of equity if you want to buy a house than you used to. And so there's a measure, aside from interest rate, that you can take to contain these side effects. The key when you do this thing is not to wait till you have a tapering. So there's a lot of your work in the earlier year, and that, for instance, making sure you don't have too much capital coming in. So there's issue of capital control, that you make reserve requirement of banks if they want to extend lending in foreign currency, that they can do it, but they have to pay a premium over it. And that's the idea, is to make sure that you don't accumulate the problem. So when the tapering comes, and if your currency depreciates, if you have managed to avoid too much borrowing in foreign currencies, you'll be able to handle this much better. In terms of handling the actual outflows, then you have to handle in reserve. Through the monetary policy or the fiscal policy, you can also handle things. Now, of course, there's no way to make a withdrawal of funds pleasant to handle. That's to be clear. But there's several tools where you can try to contain the damage. And the key aspect is to make sure that before this happens, your banking sector did not go into over-leveraging, or you don't have situation like you had in Eastern Europe, where people took a lot of mortgages in euro or Swiss francs, and then things can become dicier. There's a lot of preemptive work that has to be done. So the idea is you want to make sure, for instance, that your financial sector is resistant. Okay? So these are already measures you take before the problem happens. You make sure that there's not too much borrowing in foreign currencies, that there's not too much leverage, and Peru has been active in this respect, as have many other countries. And so when the shock hits you, you better prepare to absorb it. There's also, you can have use of foreign exchange reserves. So both. I say this is not a job where you can say you have monetary policy as usual, and then in a completely separate branch you have macroprudential. If I take the example of Switzerland, for instance, so the Swiss National Bank does monetary policy. It's also responsible for systemic financial issue, even though it's another agency, the FINMA, that actually does the bank regulation. So what you have is a cooperation between the two. So when the Swiss National Bank, they have a tool they call the cyclical capital requirement, where they can ask the political entities to require banks to provision more reserves when things are going into a dangerous situation. So I wouldn't have a clean split saying, it's the monetary policy and then you have the macroprudential and these are two separate. There's a lot of complementarities. You're handling a difficult situation, so you want to have more than one tool at your disposal and use them in a coherent manner.